Alright, welcome back. So, in today's video, I'm going to have a bunch of articles and some news to cover. And then I will look at some TA. First of all, my last video, I posted it Sunday night on my main channel. So this is my main channel. Sometimes I post videos a day early on the big channel with 8,000 subscribers, and then it comes out like a day later on the smaller channel with 1.5 thousand. And that's because sometimes I'm on the run. Alright, so futures are sort of greenish. Gold is up at 1635. I believe it was at 1580 or something like that just 2 days ago. It's a big move. Alright, a lot's going on. Let's talk about the global stimulus that's been passed this past month, and then we'll move on from there. So global policymakers have not only cut rates, by the way, this is by Tyler Durden. Global policymakers have not only cut rates 65 times so far in 2020, but also pledged some 12 trillion, 7 trillion in monetary, and 5 trillion in fiscal stimulus to reduce volatility, credit spreads, allowing credit to lead vicious bear market rally. This is a big 5 central banks, excluding China, have already bought 13 trillion of financial assets since Lehman. So that's since 2008. Although that's sort of baked into the cake already. But all of that trillion caused this bull market in the past 11 years. But they are set to buy 7 trillion this year already so far. There will be more, I believe. Here's a recap of the big numbers so far via BOFA. 7 trillion announced, promised global central bank liquidity to address 2020 crash and recession. 5 trillion announced, promised fiscal stimulus to address 2020 crash and recession to be underwritten. So that right there is 12 trillion just in the past few weeks. So far. 13 trillion Fed, ECB, BOJ, BOE, SMB have already bought 13 trillion of financial assets since Lehman. So 12 plus 13 is 25 trillion. 853 central banks cut interest rates since Lehman. 65 rate cuts in 2020 alone. And then a bunch of charts. I'll post this in the newsroom. So YCC yield curve control. Yield curve control. The yield curve on the bonds, on treasuries, government debt. UBI, universal basic income, which is just cutting checks for everyone, I guess, gets a check. I know it sounds great, but you know the consequences, right? MMT, modern monetary theory, which is, in a nutshell, saying central banks can monetize all debts and print as much money as humanly possible, and you don't have to tax the public for it, which it's a reason why it's a theory. which tell BOFA not that inflation guaranteed to rise, but that 2020 sees a multi-year low in inflation expectations. So despite all that, they still see deflation. That's what they expect. Why is that? Well, that's because we have a credit squeeze, a credit crunch, meaning people can't pay all the loans that they've taken out, and corporations, and sovereign wealth funds. So that's the milkshake theory, right? There's all this debt out there, and no one can pay it, so there's demand for dollars. So it sounds, and I agree with it to a degree, meaning I think the milkshake theory, well, it's already been in play for like many months now, if not a year. But at some point that breaks down. Because to pay your debts, I mean, yeah, you have demand for dollars, but how are you going to get the dollars? Well, that's through profit, making profits somehow. But of course, in a recession, businesses are going to suffer. People get laid off, people buy less things. Or they save money, or they just buy essential things like food and pay rent and utilities. So how would all these corporations, wealth funds, sovereign wealth funds, countries, if, by the way, they're all stimulating cutting taxes because they can't ask for more taxes because that's that destroys the economy, is deflationary. So where is the money going to come from? They're going to print it. But all of these funds, corporations, everyone out there, they have to make more money to pay off the interest and the debt. So where are they going to get the money? Well, a lot of them are getting bailouts. And these geniuses think, also, well, we could just print money and give it to the people, which is universal basic income and MMT. And it's kind of like this perpetual battle between a deflationary depression or a stagflationary depression. And they think they could play this balancing act. But I'll come back to that later. Going back to what has already been done, here is a breakdown of the latest fiscal stimulus via Goldman. Following the passage of the Phase 3 package in the U.S. Senate, we estimate discretionary fiscal policy will ease by around 7.5% of GDP in the U.S. this year and by 3.75% of GDP globally. So GDP will contract about 7.5%. Globally, 3.75%. Let's just say 4%. I bet this is very underestimated because there's more recent articles that have come out and it's much worse, and I'll get to those. So this was literally a few days ago, so it's already outdated. But the trillions of packages or whatever relief is not outdated. That's why I wanted to cover this. CBO reveals apocalyptic forecast, expects negative 28% GDP, 10% unemployment rate. Well, I mean, the past 2 weeks, about 10 million have already filed for unemployment in the U.S. 10 million is, well, it's around 3%, a little less. Because there's about 330, maybe 340 million Americans, according to data. So, that's still a lot. That's about Oh, I read this as 10 million unemployment. Well, 10 million in the past 2 weeks. It's not over. They're estimating 10% unemployment rate, which is around 33 million people unemployed, which sounds about, I think, reasonable for this year. It'll probably increase next year and the year after and the year after. Negative 28% GDP. That's not 1/3, a little bit less, right? But that's crazy. But makes sense, right? Service sector economy, restaurants. Of course, 30%. And I talked about this in my last video. I said about 30% of the U.S. economy is service sector, which is, people shuffling around paper, restaurants, servers, bartenders, baristas, whatever. And this will probably get worse. We'll probably we're going to hit negative GDP, meaning the economy is completely shrinking and contracting. One could almost argue that in the past 11 years, it's been barely breaking even. So now it's going to shrink, and that is a depression. A depression, I think, is 2 consecutive quarters of less than, I think, 2% GDP growth. Well, we're going to go into the negative. This will be the worst economic calamity ever in human history. One of many side effects of the coronavirus pandemic is I just said the word, is that it has thrown out all recent economic forecasts right out of the window. What it expects now is, at least in the short run, nothing short of a depression, with Q2 GDP expected to plunge to negative 28% as unemployment soars to 10%. The following are CBO's latest preliminary estimates based on information about the economy that was available through this morning, and which include the effects of the economic boost from recently enacted legislation. Gross domestic product is expected to decline by more than 7% during the second quarter. If that happened, the decline in the annualized growth rate reported by the Bureau of Economics and Analysis would be about 4 times larger and would exceed 28%. Well, they're saying exceed 28%. Those declines could be much larger, however. See, that's now, right? Now, what if they keep this lockdown past May? What if we get a second wave later? It could be much, much worse. And I'm just talking about for the rest of this year, or maybe the next 10 to 12 months, something like that. In the long term, yeah, it's going to be worse. It's going to be much, much worse. We know that. And that's scary. The unemployment rate is expected to exceed 10% during the second quarter. That's just in one quarter. Usually when there's a recession, it takes a year or something, or a little bit more, to reach... I don't want to say that long, but it takes many months, a couple quarters, to reach that 10%, like in 2008. This took 2 weeks. In part reflecting the 3.3 million new unemployment insurance claims reported on March 26th and 6.6 million new claims reported this morning, the number of new claims was about 10 times larger this morning than it had been in any single week during the recession from 2007 to 2009. 10 times greater in 2 weeks. Now, you have to understand, when people lose their jobs, those people are no longer spending money on discretionary spending. What does that do? Well, sales drop. And then people who work at the other company who still have jobs, then they get laid off. And it's a vicious cycle that keeps going and going until we hit rock bottom or somewhere. And that's the problem. So when 10% of the population is unemployed within 2 weeks, and it's probably going to be worse. It's probably going to be 20% once the lockdown's over with, probably. So I expect 20% or more by the end of May or June. Now, what does that do to the economy when a quarter of your people don't have jobs anymore? I mean, that means that more people are going to lose their jobs because people are going to stop spending. And that's the vicious cycle. I mean, by the end of summer, we could have enormous unemployment. Like, I don't know. We've never seen anything this bad. By the end of 2020, I mean, it could be 50% easily. That means, and that I'm talking about the working population. That's only like 70% of the country. There's still kids and elderly who didn't even have jobs, and then a bunch of disabled and people on unemployment for years, which was a lot. Like I mean, don't quote me. I think it's like 60 million Americans didn't have jobs prior to this, so 270 million had some sort of job. Many of them had part-time. Oh man, it's gonna be bad. It's gonna be really bad. So it's another reason why I went in the newsroom and I'm like, stop posting about endless conspiracies. It's a waste of time. You're not gonna. It's not. It doesn't make any difference. You have to understand, like, all the conspiracies out there. A lot of them are true, but a lot of them are not. And constantly, it gives you dopamine hits in your brain to constantly watch these things and give yourself fear. It could become addicting. And, there's a lot of YouTubers out there who make like, I mean, if you have 10,000 views per video, you put out 5 videos a week, you make like $200 per 10,000 viewed video. It's $1,000 a week. You're making a living. So keep that in mind when you constantly watch these things. Most of the time it's really a waste of time. It doesn't help you. Like the person who watches endless fear porn, do they get ahead in life? Do they make a difference in the world? No. They just know a bunch of shit. They're scared and could cause some serious mental problems in the long run. So don't post that stuff in my chat groups, because you're wasting your time and then you're wasting other people's time who happen to click on it. Right now, you should be more worried about keeping your job, finding a new one, or building a business. Or if you have extra income and savings and you still have a job, then you should be looking at investing and hedging against all of this. And that's why I'm here. Okay, that's about as far as the CBO will go, as it admits its economic projections, especially for later periods, are highly uncertain at this time. Alright, I'm done with this article. Alright, the Federal Reserve's One Last Hail Mary, authored by Alexander DeLuce via goldtelegraph.com. Alright, over the last few weeks, the Federal Reserve has been in utter desperation mode to try to revive and keep the American economy on life support. What many in the mainstream media have failed to include in this recent nano-zombie economic narrative is that the virus was just the pin of one of the biggest bubbles ever created, which we call the central bank bubble revolving around the U.S. sovereign bonds. Bond market, guys, is much, much greater than the stock market. I'm not exactly sure how much greater, but it's like 5, 8, 10 times greater, something insane. Everything bubble, financial assets relative to disposable personal income. So you can see these peaks, and they're perfectly timed with every recession. The 2001 NASDAQ bubble, dot-com bubble, housing bubble. Here's the everything bubble. And we just started falling. Just started. Before we dive deep into this, let's start with the Fed has been doing to combat against the nano zombie and to keep markets alive for the time being. To begin, welcome back to the era of the printing press. But this time, they have made it clear they will conduct QE infinity if this is a prolonged depression, which it will be. You know, I said QE infinity like months ago. I wonder if I was the first. Maybe I wasn't. I don't know. For some perspective, previous QE programs were QE1, 1.7 trillion, QE2, 6 billion, QE3, 1.6 trillion. With this latest being 1.6 trillion, but this is a little bit older article. Or this isn't correct. I mean, I just went over, right? The Fed did 6 trillion. The IMF did 5. We talked about it. It's like 12, 13 trillion already. An overwhelming number in such a short period, making previous QE programs look like peanuts in comparison. In fact, the Fed printing roughly 970,000 every second last week to keep the market afloat. To validate that the Fed is artificially keeping the market alive, just look at this next chart. So their balance sheet, just a month ago, guys, it was like at 4.16 trillion. In 2019, towards the end, it was at 3.77. This is before they started repo operations. This was repo operations. This is the past 2 weeks because of the nano zombie. Boom. This chart showcases that while the Fed balance sheet has shot up to 5.2 trillion, corporate earnings have plummeted. The market is clearly on life support with the Fed as its temporary backstop. Presently, the aviation, hotel, and automotive industries, to name a few, are in major crisis. This applies to all businesses, but since 2008, companies have taken advantage of prolonged zero interest rates and have gone on total debt binge, with the majority of this debt going strictly to share buybacks and dividends to shareholders. Now remember, there's no more buybacks, and a lot of companies now are cutting their dividends. So if there's no more buybacks, no more dividends for shareholders, why risk holding these stocks, hoping that the market's going to go back up? Because who's going to make the market go back up? Because corporations were causing the previous rally for the past few years. Everyone else, I mean, you're either all in or you've ran out of cash, especially if you lose your job. You're not going to get dividends. So you can't live off of, let's say, a large long-term hold in any of these companies. And then you also risk the share price just dropping massively. And we have baby boomers retiring or going into early retirement, meaning they're going to pull out all their funds out of the markets earlier because they're scared they're going to lose it. And then, as of late, I don't have an article on this right now, but pensions, I posted it like last week, pensions are at risk of blowing up. The Fed will bail them out. I mean, and why are pensions blowing up? Because pensions invest in the stock market. Well, the stock market just fell 35%. And they were in trouble before all of this. They were in trouble with the stock market all-time highs. Now they're probably underwater. And Schiff's last video, he made awesome points. So if everyone's going to get a bailout, does that make them become more stringent with their spending? The states and the pension, or well, the states. No, they're they're just gonna know that they're gonna get bailed out every time. So then they'll just keep spending money and going further into debt, and then the Fed's gonna keep printing even more, and then that's what's gonna happen. That's why the dollar is gonna fall in the end. And the milkshake theory, like I said, short term I think it is happening. Long term, not. It can't. All the unfunded liabilities, all that is like 260 trillion. It is expected that the federal government will bail out some of these companies out, and that's pensions. Now, they're also doing this with banks, with corporations, with individuals sending out checks now. That's going to become like a normal thing. Like maybe every quarter you get like a little $1,200 check. And then they have to buy all the government debt, the treasuries, because, well, they just said they will, because they don't want interest rates to spike. They don't want the bond market to blow up. So foreign countries who probably need the cash now are probably offloading, and they are, the next articles about that, are offloading all their bonds and treasuries to the Fed. So the Fed's printing up even more cash to buy those bonds and treasuries, and then the foreign countries get the cash. And then they'll go and spend it. And then there's more and more dollars in circulation globally and in the US. We're going to be in a wash of cash very soon. The only question is the credit market. How long is there going to be a demand from the credit market for the cash? And how is all of those corporations, everyone, going to get their hands on the cash to continue to pay their debts if we're in the greatest global depression ever and there's less discretionary spending? See what I'm saying? See how this all... I'm not an economist, guys. My minor was, but they taught me Keynesianism. A lot of the things I learned was from Peter Schiff. He needs way more credit. He's probably the best financial economist over time. All right. It is expected that the federal government will bail some of these companies out with unprecedented stimulus package passed last week, which displays we don't live in a real capitalistic society. Wealth effects have been a primary mandate for the Federal Reserve for the past 3 decades, beginning with Greenspan. But we now face a severe issue, which resides in the bond markets. The Fed has made it very clear that they will conduct QE forever if needed to normalize things. However, the more and more they print, and as more stimulus gets announced from the U.S. government, the confidence in the U.S. dollar will begin to dwindle. Many prominent investors are calling for a significant dollar rally as they believe the USD will forever be the world's most sought-out currency given its reserve currency status. However, they fail to realize that this is much different. This is a much different world we are navigating through than the 2008 financial crisis. For starters, this will not be a temporary few-month recovery. There are many signals being sent to the market that we are entering a Great Depression type environment. As CNBC reported just 2 days ago, the Federal Reserve itself has made estimates public that the unemployment rate could hit 32%. So the last one was 28%. The Fed actually came out and said 32%. And you know what's funny? You know what's scary? They usually underreport bad news, right? Because that goes against everything they're trying to do, which is build up confidence. Because this entire financial system in the global economy is built on not just supply chains, just on time supply chains, globalization, but it's also built on confidence via credit and fiat currencies. So, like I said, I was just saying that off the top of my head. I'm expecting 50% by the end of this year. They're saying 32. It'll probably be somewhere in the between that, 40. So 40%, almost half, lose their jobs. That is beyond Great Depression. All right, let me read further here. Unemployment rate could hit 32%, which would have 47 million Americans out of a job. So I said 60. For comparisons, during the Great Depression of 1933, peak unemployment was 24.9%. Wow. So the greatest depression ever that you read about in your history books, unemployment was only 24.9%. And Schiff brought it up. Back then, we had a real economy. It wasn't a service sector economy. It was manufacturing. Back then, people were way more self-reliant. They had way more savings. So just imagine how bad this is going to be. That's why I'm telling you guys, it's time to get serious. Because it's going to be serious. Like, I mean, on top of that, we also have the nano zombie. It's unbelievable. This is like, we're living in history. May you live in interesting times, that saying. I think it was an Asian saying. Yeah, this is going to go down in history forever. People are going to talk about it. You're going to talk about it when you're older, if you make it. And you could tell great stories. Hopefully. But it's going to get dangerous out there. It really is. It's worth revisiting the Great Depression, which had devastating effects. Personal income, tax revenue, profits, and prices dropped, while international trade fell by more than 50%. So back then, when there wasn't even globalization, not as much. There always was global trade, but not to this extent. Especially back then with technology, they didn't have huge freight liners, and like your banana doesn't come back then. Your banana, maybe it came, but it didn't come from halfway around the world. Like every little product you see, like if you look around right now, a part of it was made halfway around the world. If not the metal itself or the plastic itself was shipped from halfway around the world. Like a pencil is made in like 20 different countries. Schiff was talking about that as well. Let that sink in. And this is a global thing. So let's say the US does come out of lockdown sometime in May. That doesn't mean that Europe will. Doesn't mean maybe by then China will fall back into it. Because they did the lockdown too soon or too abrupt. You know what I'm saying? Like, it's going to take turns. And there might be second waves. Hopefully by then we have ways to cure it or at least manage it for people who get seriously ill. Countries have been preparing for this moment since the financial crisis, as this chart showcases. So since 2008, I've been saying this forever. This is why it's a guaranteed sort of investment. Gold is, because central banks have been buying it hand over fist since 2008. They're not stupid, guys. They might pretend like everything's okay, but they know. They have real data. They know everything that I talk about. I guarantee it. Chart 2. Central banks shift to net purchasing in 2010 of gold. Look at that. By the way, there was just an article that Putin he made it illegal to sell gold to the public because the government's buying it all up. If that's not an early indicator of what's coming, like for prices for the metal, I don't know what is. Also, I think mining stocks are, if they haven't bottomed, they're very near it. But I think they've bottomed. I've loaded up of what I can, and I'm just sitting back, waiting. It's gonna be huge. Like, this is the ultimate buying opportunity because of the huge sell-off in mining stocks. So, of course, you have to pick the right ones. Or at least, if you don't want to pick individual ones, you could always find a couple good ETFs and just sit back, relax, and just watch it grow for the next few years. Since the 2008 financial meltdown, central banks have gone from... And go to my website. All right. Since the 2008 financial meltdown, central banks have gone from being net sellers to being net buyers of gold, and demand from central banks is currently at 50-year highs. 50-year highs. Why might you wonder? Well, for one, it's money which is recognized universally, which with zero counterparty risk. I will save why it's money for another report. Still, one of the primary reasons why there is such unprecedented demand from central banks is because they do understand that there is historic debt circulating the global economy, which eventually has been dealt with. I believe the grand game plan that these... Now, I agree with this. I've been saying this, right, for years. I believe the grand game plan that these academics at these central banks are planning is to allow inflation to run hot for the foreseeable future until this debt becomes more manageable. By allowing inflation to run, debt will become cheaper to service. These inflation concerns could be why foreign central banks dumped more than $100 billion in treasuries in the 3 weeks to March 25th. $100 billion in treasuries. And it is on track to be the biggest monthly drop on record. See, like I said, they're all going to sell them. Well, they need the cash. That's one reason. Another reason is they might be pricing in inflation. Although the price of the bonds themselves are going to go higher, right, they will... Well, no, they will sell them. The price of the bonds will go down. That's why the interest rate on them will go higher. Because nobody will want them. Because people think that the money will be losing more value through inflation than the interest being paid out on the bond. Does that make sense now? A lot of people, it's hard for them to understand treasuries. But that should explain it. So rewind this and listen to it a couple times. If the rate of inflation outpaces the interest you get on the bonds, then why hold the bonds? Nobody wants bonds. So the 30-year bull market in bonds blows up. That's what forces the interest rates higher no matter what. Because nobody wants them. Get it? So then they offer higher interest for you to buy the bonds. But the problem with all of this is that's the last thing the central banks want right now. Maybe in the future it'll happen no matter what, which it will. So when the bond market does blow up, the interest rates will spike. I mean, during the 80s, what's his name? The last central banker who raised rates. It escaped me. Well, you raised them to almost 20%. If interest rates on 20%, if we see on the world reserve currency, and we see bonds go up 20%, the interest rate on go up to 20%, everyone defaults, like globally. And the unemployment, that's when you see only 1 or 2 or 3 out of 10 people have jobs. Now imagine a world where only 1, 2, or 3 people have jobs out of 10 with high inflation. So you can't even get food, or everything's so expensive, you're starving. That's the severity of all this that they have done with all this bubble blowing and kicking the can down the road, because they're so scared. They keep reinflating the bubble. They have been for decades now, because they're so scared of what will happen. But by kicking the can down the road, it just makes the inevitable even worse. So I think their plan is we're going to have massive inflation. The debt's more manageable. Then raise interest rates. even then, everyone's going to default and then go back to a gold standard and just reboot the system. But man, is it going to be painful. Like, the U.S., like, everyone's going to be third world. Everyone. Like, if you have land, go plant a garden. By the way, I posted in the newsroom that video. He was talking towards the end of the video of how the supply chain's breaking down. It was a good video. All the videos I post in the newsroom are good videos, right? They're better than me, probably. All right. Now, the Fed is trying to stay ahead of this, implementing a backstop by introducing a temporary repurchase agreement facility. This program allows central banks to swap treasuries for dollars. It is quite evident that these central banks are in urgent need of these dollars so they can spend quickly. By the way, they want to spend quickly while the dollars are still worth something. Like I said in my previous video, if I was Trump, I'd probably do the same as the central bank. I would do all this because you want to spend it. You want to spend it while it's still worth something. That's why they're getting infrastructure bills being sent through, another $2 trillion or whatever. Spend it while it's worth something. Build up your infrastructure and prepare for what's coming while you can. Either way, it's already too late. Like, we're going to see some serious stagflation, if not hyperinflation. I hope it doesn't get to hyperinflation. If it gets to hyperinflation, I mean, it's Mad Max. Nobody wants to live through that, guys. It's Venezuela stuff. You might be wondering as to why the USD is currently holding up. Well, it's because many investors and money managers have yet to realize this very fact with regards to the upcoming inflation. Many believe, like in the Great Depression in the 1930s, we are on the verge of a deflationary episode due to a credit crisis, which I also believe. That's why you don't see gold at 3,000. That's why you don't see the mining stocks at all-time highs right now. It's because most of these people haven't figured it out yet. And that's probably because the universities, all the universities pretty much, they have Keynesians in economics courses. And believe me, I know. I've one of my professors in economics used to go to the Fed and get not briefings, but like courses or lessons. And then they would come back and tell us the same stuff. And it's all Keynesianism. They're failing to comprehend a very important variable at this present moment. More and more supply chains are being absolutely eviscerated by the day, meaning fewer and fewer goods will be produced in the foreseeable future until this pandemic gets sorted out. Right, I was saying that. But before that happens, there will be much more panic economically as critical necessities that we humans need is beginning to take a hit, which is food. Food supply chains in developed economies are beginning to become strained, and countries are already starting to stockpile food instead of exporting it. Oh, another thing. Other countries now, like in the South America, the South American continents, all over the world, just like we saw India, they don't want to export any of the pharmaceuticals anymore because they need it for themselves and their own population. That's going to happen with like probably a lot of things, with maybe most things. Well, the US has been benefiting the most from globalization. Well, now it's going to get hit the hardest from globalization. And we don't have a manufacturing industrial infrastructure like we used to. Like I said, it was only like 12% of the economy. It's probably even less now. Especially with these car companies, who knows? Like, that's what's scary about all of this. If other countries are hoarding and they refuse to export to the US, we are royally, royally screwed. And at the same time, when goods come into the US, what do we export? Well, we export dollars. And what if they're not? So if we're not importing goods to live off of, that means we're not exporting dollars. Where do those dollars end up? here. What happens when more dollars are chasing less goods? Stagflation, inflation, runaway inflation. Boom. There you go. That's all you need to know. It's not that hard to explain. Hopefully this nano zombie goes away and the supply chain, the globalized supply chain starts, recovering quickly. And in the meantime, the U.S. will have to. It's national state of national necessity or emergency to rebuild infrastructure in the U.S. So you better hope Orange Man gets reelected and actually does that, where he gets infrastructure money and then he gets maybe more stimulus. And then with all of that, it's time to retool the U.S. and start making our own stuff. If this isn't a wake-up call, I don't know what is. People were warning about this. I've been warning about this ever since I've gone public. Like, the U.S.'s biggest weakness is that we don't make anything anymore. And that's why we used to be the richest country in the world. In the 1800s, in the early 1900s. It's because we made everything and we exported it to the world. All right, next on top of unprecedented quantitative easing coming from the Fed, there is a pipeline of liquidity in the form of approved $2 trillion stimulus bill passed with many government officials calling for more. The American economy is currently being flooded with cash to keep things afloat. The big story here is looping back to the biggest bubble ever created, which is the bond market. And the question is, how will the Fed keep it from utterly collapsing? The Fed has the following to worry about: the 10 trillion corporate bond market, the 16 to 19 trillion commercial real estate market, which is shut down, the 23 trillion treasury market. Right. So I forgot to talk about this. The real estate commercial market is enormous, guys. So all those, not mainly malls. I mean, there's a lot of malls in the U.S., but there's a lot of these outdoor. They're not malls. They're like shopping centers, right? Where you have just a bunch of crap. There's always a Target, Walmart. Then you get a hardware store, and then you get maybe a chain of smaller businesses. Well, a lot of those are going to end up empty, and there's laws coming out where the renter can't even ask for the money. It's just a mess, guys. The real estate market is just going to be utter devastation. You're going to see empty stores everywhere. Everywhere. Psychologically, it's going to mess with Americans. That's going to reinforce them not to spend recklessly, not to spend money recklessly. The 10 trillion corporate bond market, I think it's more than that. Maybe it's 10 trillion now after this. I don't know. We'll see. The 23 trillion treasury market. All in total, that is what? 30, 40, 46, 49, 50 trillion. If you round it up. 50 trillion. So, is the Fed going to print that much? To water over? To liquefy? To somehow bail out this 50 trillion gaping hole that's about to emerge? Probably, if they have to. Maybe not a fully 50 trill, but maybe another extra 10 or 20 to... Oh man, this is bad. The only way the Fed is going to deal with this is by printing endless amounts of money, which is going to debase the USD purchasing power in the coming years dramatically. As more and more money is printed, one of the most important charts to pay attention to is this one. Gold. So as you can, it's circled right here. This is the Fed balance sheet, the blue, the background, the blue. And then this orange line is gold, the price of gold. So as you can see right here, you can see a correlation. The Fed's balance sheet exploded because of the of the 2008 financial crisis and what happened to gold. Well, first it dipped, and then it just went into a ginormous bull market. Well, look where we are right now. This is pretty much this. Actually, I have been showing you guys the relationship to the gold price to the previous bull markets, and that's what I'm showing you. Except in the background, you have the Fed's balance sheet. And you can see the balance sheet right here goes from like 3 point something trillion to 5.2, and it's probably going to end. Oh man, I don't know. It's probably going to end somewhere in the 20s, maybe higher. I don't know. At that point, Wall Street cannot ignore gold. It's pretty obvious. I mean, when you go to the store and prices are noticeably higher, can't ignore it anymore. So, and that's why there's MMG and the website and the private group, because we want to be there for this. Alright, gold is the perfect piggy bank. It's the anchor of trust for the financial system. If the system collapses, the gold stock can serve as a basis to build it up again. Gold bolsters confidence in the stability of the central bank's balance sheet and creates a sense of security that came from Dutch central bank, summed up a Dutch central banker. Alright. So there's more, but I'm already at 51 minutes. But this was a good video. I'll talk about oil, energy, and more about gold, because the gold futures market's breaking tomorrow. Let's look at the S&P real quick. Oh, here's the bond market, and then I drew this for private members. I'll talk about this later. That's the bond market. Let's just look at the Dow Jones. Right now, today we had an up day in the markets. And right before the markets opened, we had a 6.6 million unemployment economic data come out. A bunch of other economic data, and it just all looks screaming depression. It's all horrible. But the markets went up. So, let's go to a daily chart. And this will either be a dead cat bounce or a rebound. Right? Like a giant bull trap, or this, none of this is enough, and the Dow could fall another like 10% or something. It could fall down towards anywhere from 18 to 15,000. The next leg down. I do not know which it will do next. What I do know is I'm pretty confident Trump and the central bankers will keep the prices above the 61.8 fib retracement for the next month or two, as long as it takes for this nano zombie to go away, and then everyone will have the excuse to buy the dip and then get the bull trap going, right? That's what I think their plan is. That's what I would do. Or they just let it fall another leg down, and then, I don't know, just come out with endless more QE and then get it back up. But it'll be much, much, much multiples harder to get the market to get back, to go back up if they let it fall again. So I'm pretty confident they're going to put in a backstop. If need be, overnight with repos or whatever, they'll start buying stocks themselves. I don't know. They're not going to let it fall below 20,000, 20,700. They can't let it fall below that. At least 20,000. The 61.8 fib retracement. It's also major support if you zoom out from previous price action. Same goes with S&P 500. So I think it's more likely the prices on for markets will go higher despite pretty much economic implosion. But I'm not very confident. Like, I really don't know. I give it a 60%, maybe a 70% chance they will just keep the price for the next 2 months, sort of trading sideways, slightly down. You know, we could fall a couple more hundred, maybe even 1,000 points, but they will not let it fall lower. They will come in with more QE, and then the nano zombie subsides, and then everyone buys the dip, thinking back to normal, which in reality, like on the Wall Street cheat sheet, it's the bull trap. All right. But I also wouldn't be surprised if it just tanks again and we go much lower. I don't know. You wait for the market to tell you what it's going to do. I'm not a prophet. That's what professionals do. They wait for the market to tell them what the market's going to do. Because the market knows best, not you. All right. And not the central banks. If the S&P does fall, we have some awesome shorting opportunities in the private group, but it could fall to 19. It could fall to 2,000 or 1,900, somewhere around this area. There's also some support at 2,200, so we'll see. But it's more likely if it falls, it's going to fall down and test 1,900 area. I want to talk about oil, but this video is too long. Smash some likes, leave anything in the comment section. Please share my videos. It's the only way my channel grows, and I will continue to do this. Until next time.